where you would then have to hire a third party, which is a TPA, to manage that $1 million SIR, versus if you had a deductible, the insurance company will actually manage that deductible. One of the questions we had last week was SIR, which is a self-insured retention versus deductible. And for this context, we're going to talk about a liability program only, not property, liability only. A self-insured retention is typically going to be structured on an insurance program where you want to take a lot more, basically a much higher deductible or take on much more risk. Now, a self-insured retention is not a deductible, and we're going to talk about that. So the idea behind a self-insured retention on a liability program is it's typically going to be at least a six-figure, if not higher, 6 to 7 figure retention. Now, what do I mean by retention, right? On the SIR, the difference, and we'll get into that briefly, between the SIR and a deductible is most of the time on the SIR programs are structured to where you're responsible for all of your the management of the claims and the defense of the claims up to a certain amount. And at that amount, the insurance company will take over and then provide provide additional coverage. Now, so for example, we have a $1 million SIR, $1 million self-insured retention. Most of the time it's structured where you would then have to hire a third party, which is a TPA, to manage that $1 million SIR, versus if you had a deductible, the insurance company will actually manage that deductible for you. And then at the end of the claim, they will net your deductible out, or essentially you'll have to pay for the deductible. So the SIR is a lot more upfront cost for you. You have to hire a TPA, a third-party management company that specializes in insurance claims to manage that. But the trade-off in that is you could save large dollars, right? So if you have a TPA, if you have a large program, if you have a large liability program, they can be beneficial. Where I caution a lot of people, especially on the multifamily side, is you might have your program out for for bid. You might be trying to look at other options, and I actually had live examples of this happen where someone took a self-insured retention option versus a deductible option because it was cheaper. Well, absolutely it's cheaper, but they didn't realize they actually had to manage a lot of their own claims. They had to pay for additional claims costs, which with a deductible they would not have had. So in essence, very basic. On an SIR, self-insured retention versus deductible, you're responsible for a lot of your claims management fees and a lot of upfront fees, whereas with a deductible, the insurance company will actually handle a lot of that for you on a first dollar basis and then request a deductible at the end of the claim. Any questions on this, feel free to give us a call or reach out to us at spartanriskmanagement.com.